Imagine a world where the rise and fall of civilizations, from ancient Mesopotamia to today's global superpowers, rests on one quiet, powerful institution: banking. Banks do not merely store money. They shape trade, influence governments, and determine how economies grow or collapse. How did a system born out of basic necessity become the backbone of the modern world? To understand that, we need to trace banking back to its origins. Welcome to Genesis of Success. Let's look at the evidence. Our story begins more than 4,000 years ago in ancient Mesopotamia. Temples and royal palaces functioned as the first financial institutions, storing grain, silver, and valuables. Lending already existed, with interest rates and repayment rules written into law, most famously in the Code of Hammurabi. These early systems introduced the core idea that still defines banking today: trust backed by authority. Centuries later, the Persian Empire elevated financial administration to a new level. Under Emperor Darius, standardized coinage was introduced across a vast empire, along with an extensive road network that enabled trade, taxation, and economic integration. For the first time, a unified financial system supported a multi-regional economy. This was not banking as we know it today, but it was a prototype: centralized control, standardized money and infrastructure designed to move value efficiently. As financial practices evolved, the Roman Empire took banking even further. Roman bankers, known as argentarii, operated as professional financial intermediaries. They accepted deposits, issued loans, facilitated payments, and managed accounts for individuals and businesses. Promissory notes, contractual credit arrangements, and standardized accounting allowed wealth to move without the constant transfer of physical coins. This financial infrastructure supported Rome's vast economy, military expansion, and long-distance trade. When Rome fell, its political power disappeared, but its financial concepts endured. In the medieval world, Europe faced a fundamental problem. Trade routes were dangerous. Carrying gold or silver across long distances almost guaranteed theft. Commerce, pilgrimage, and international exchange were severely limited by this risk. The Knights Templar changed that. In the 12th and 13th centuries, they unintentionally solved one of the greatest economic challenges of their time: how to move money safely without physically moving it. Pilgrims traveling to the Holy Land could deposit funds at a Templar house in Paris or London and receive a written credit document, allowing them to withdraw equivalent value in Jerusalem. This was not barter. This was deposit banking based entirely on trust in an institution. For the first time, value moved as information. The Templars standardized written financial instruments recognized across borders. These documents were honored because their network was unified, disciplined, and credible. They operated a pan-European financial system with branches coordinated across kingdoms. Funds deposited in one political system could be accessed in another, without currency chaos or local disputes. Their greatest asset was not gold, it was credibility. When the Templars were dissolved in the early 14th century, their financial methods did not disappear. Italian banking families absorbed them. Nation-states later institutionalized them. The Templars did not invent modern banking, but they proved it could work at scale. Across Asia, banking evolved along a different but equally advanced path. In China, paper money was introduced centuries before Europe adopted it. During the Tang and Song dynasties, state-backed currency and credit systems dramatically improved the efficiency of trade. Later, private draft banks allowed merchants to move capital across vast distances without relying on physical currency. Another confirmation that value could travel independently of metal. After centuries of fragmentation in Europe, banking was reborn during the Renaissance. In 15th century Florence, the Medici family built the most powerful banking network in Europe. Unlike earlier moneylenders, they professionalized banking across multiple cities, including Florence, Rome, Venice, Milan, London, and Bruges. They refined double-entry bookkeeping, expanded bills of exchange, and developed complex credit systems that allowed capital to flow internationally without physical gold. Crucially, the Medici understood that banking power and political power were inseparable. By financing popes, monarchs, and city-states, They embedded banking directly into governance. Banking was no longer a supporting function of the state or the church. It became an independent force capable of shaping politics, culture, and economic development. From the Medici onward, banking shifted from institutions to dynasties. Families like the Rothschilds built cross-border financial networks that financed governments, wars, and industrial expansion. In the United States, figures such as J.P. Morgan consolidated industries and stabilized markets during crises. As financial power grew, so did systemic risk. The 20th century marked a turning point. Central banks were created to oversee money supply, stabilize currencies, and act as lenders of last resort. Banking was no longer just private enterprise. It became a pillar of national policy. Today, banking operates on a scale unimaginable to earlier civilizations. Global institutions manage trillions of dollars in assets, facilitate international trade, clear payments, finance governments, and provide liquidity around the clock. Modern banks are complex ecosystems, spanning retail banking, commercial lending, investment banking, asset management, and custody services, supported by risk management, regulation, and advanced technology. Behind the scenes, global financial infrastructure connects everything. Transactions that once took months now settle in seconds. But with this scale comes influence. Banks today are deeply intertwined with economic policy and political power. Governments rely on them to issue debt, stabilize markets, and sustain economic growth. In return, financial institutions shape regulation and global capital flows. Banking is no longer just part of the economy. It is the circulatory system of the modern world. From ancient temples storing grain to global institutions moving trillions at the speed of light, the evolution of banking mirrors the evolution of civilization itself. The tools have changed, the scale has changed, but the core function remains the same. Banking exists to connect savers and borrowers, to allocate capital, and to keep economies moving. Understanding this history is not nostalgia. It is understanding the invisible structure that governs modern life. Because to understand how the world works today, you must first understand how money learned to move. Thank you for watching Genesis of Success. If you found this video helpful, subscribe, like, and leave a comment. We read them all, and if there's a topic you want covered, let us know.